All right, today we're going to do something a little different. We're going to peek inside the mind of a day trader and break down their thought process second by second during one incredibly high-stakes morning in the market.
So let's just start with this quote because it perfectly captures the feeling of the market on this particular day. I mean, it sounds like pure gambling, right? Like you could just throw a dart and make money. But as you're about to see, behind that chaotic feeling, there's actually a super structured, disciplined plan at work.
So what creates that feeling of pure chance? Well, it all starts with the setup. We have a market that is stretched to its absolute limit, creating a tension you could practically feel through the screen.
We are looking at a perfect storm. It's August 15th. Both the S&P 500 and the NASDAQ are trading at record highs. And, just to pour a little gasoline on the fire, there's major economic news scheduled to drop at 10 a.m., which is a guaranteed recipe for volatility.
And this is where it gets interesting. You've got a market where every signal, every headline is screaming up, up, up. And our trader, he's looking in the exact opposite direction. He's a contrarian, and he's betting against the entire crowd. So how in the world do you bet against a runaway train? Well, you don't just jump in front of it, that's for sure. You need a very precise game plan. Let's break down exactly how this trader is thinking about it.
In his own words, his bias for the day is set. Simple as that. He's not buying into the hype. His belief is that what goes up this fast has to come down eventually.
And you got to admire the discipline here. It's one thing to have a bearish bias, but it's another thing entirely to have the conviction to say, I am not even going to touch the buy button when everyone else is in a buying frenzy.
Now this is the core of his strategy, going high to go low. What does that mean? It means he's not just jumping in and selling right away. No, he's patiently waiting for the market to push even higher, to give him a better price, a better entry point, to bet on the drop.
And for anyone who might not be familiar, this is the tool he's planning to use. Short selling is basically just flipping buy low, sell high, upside down. You sell high first, and then you hope to buy it back later at a lower price. It's the main way traders can profit from a market they think is overvalued.
See, this isn't just a gut feeling. It's a plan based on hard data. He's already identified a specific price ceiling, a technical resistance level that's known as R2. He's predicting that's where the buyers are going to run out of steam. That is his spot.
Okay, so everything has been building to this. The all-time highs, the contrarian plan, it all comes down to one single pivotal moment, that 10 a.m. news release.
This is the million-dollar question, isn't it? Is the news going to add more fuel to the fire and send prices into the stratosphere, or is it going to be the tiny pin that finally pops this massive bubble? Our trader is betting on the pop.
But of course, the market throws a curveball. Instead of rising towards his target, it starts falling right from the opening bell. So the trader's focus immediately shifts from that price ceiling he was watching down to a price floor he had also mapped out, a key support level between 23,790 and 23,770. And in the final 2 minutes before the news, the market is just dancing on a knife's edge, right on top of this zone.
And then bam, the news drops, and it's bad. Consumer sentiment is way down, which is not a good sign for the economy. This is exactly the kind of catalyst that can shake up a confident market.
The reaction is, well, it's insane. The market instantly dumps on the bad news in this massive knee-jerk reaction. But then, just as fast, it snaps back with an equally violent recovery. I mean, this is pure, unfiltered volatility in action.
So, with all that chaos, did the analysis even matter? Did the homework he did before the market opened actually hold up? Let's get to the resolution and see how it all played out.
And here is where it all comes together. Remember that critical support zone he identified before the open, between 790 and 770? Well, the absolute bottom of that chaotic panic sell-off was 802, just a few points above his zone before it reversed hard. His predefined price floor, S2, held like a brick wall.
And you can hear it in his own words right here, the confirmation. His plan, his analysis, the levels he mapped out hours earlier, they were respected. The chaos was contained within his structure.
But look, one good call can always be luck. The real lesson here isn't about one single prediction. It's about the framework that makes this kind of disciplined trading possible day in and day out. It's about having a system.
And this really gets to the heart of it all. Professional trading isn't about being a fortune teller. It's about managing risk with a system that you follow religiously, whether you win or lose.
And this is what that system looks like in the real world. To get funded by a pro firm, traders have to pass these intense evaluations with really strict rules. It's not just make money. It's don't lose too much, don't make too much in one day. It forces you to be consistent and manage your risk.
And this is the career path, really. You pass the test by proving you're disciplined. That gets you a pro account, where you're trading the firm's money, not your own. Then you build up a small safety buffer, and after that, you get paid out on your profits daily. The whole structure rewards consistency, not wild home runs.
So, I guess I'll leave you with this question. After seeing the plan, the chaos, and the system behind it all, do you think successful trading is really about predicting what's going to happen next? Or is it more about having an unbreakable framework to manage the chaos that's happening